You will have disproportionate gains in short time frames, but you've got to count in years. You've got to count in years for those. If we're talking about 108,000 gold and 14,250 on silver, it's not next week, it's not next month, obviously, but you'll be shocked at how much things will change and look at how much we were at below 1,000. We'd never made the 1923 high. That was 2011. Then we were stuck at 2,000 for an extended period. Now you're on the door of 4,000.
After breaking out from a 4-month consolidation period in early September, the price of gold has continued to trend strongly higher in recent weeks. On Tuesday, commodity analysts at Capital Markets released their fourth quarter price forecasts, making significant upward revisions to both gold and silver. Meanwhile, the U.S. government is once again on the cusp of a shutdown, bringing renewed focus to the nation's massive and growing debt. A leading Canadian bank believes this will be the latest driving force for gold through the end of the year. Veteran analyst Francis Hunt envisions nothing short of a moonshot near $18,000, arguing that gold's true bull market began back in 1913, when the Federal Reserve was created, marking the start of fiat currency debasement. Francis Hunt has just applied a ruthless piece of technical Fibonacci analysis to gold's massive multi-decade move. His target isn't just a few $1,000s higher. In fact, he warns that such levels may spark sharp corrections and even bubble talk, but insists this would simply be a natural phase of the bull market. Hunt believes gold still has the potential to climb more than 7-fold from current levels, pointing out that later waves in bull markets often move faster and with far greater volatility. According to Hunt, 1913 marked the point where systematic debt creation and fiat debasement truly began. Before the Fed's establishment, he notes, gold held remarkably stable purchasing power for decades, while the dollar's value remained effectively constant. From that moment onward, however, debt-driven inflation, 2 world wars, and rapid financialization completely reshaped the system. Fast forward to today, the greenback is enduring a bruising 2025, down more than 9% already this year. Concerns about Fed independence and escalating trade war tensions have only added fuel to the fire, mechanically lifting gold's value in dollar terms.
We're going from here, the low. In fact, it's there. It's slightly lower there. We're going from here in 99 July. This is how you do a Fibonacci extension. You grab that low. You take it to the high, that is $1923. So you're going from $252. Brown's bottom. We all know about Brown's bottom, how he sold it on the cheap, knowing the inflation was coming, pretended to be stupid and say, well, we need the money, and sold out Britain's gold to a different name on the clipboard. Yep, we can only guess as to whose name that was. And we run this up to here and we go, okay, we want 1.618. We want a number that represents 1.618. That means it is 61.8% longer and further than the bottom of the bear market on this new 5-leg upswing, which happens to go 61% further. So with drawing that, you will see that I've captured the low there, round about 1,045, maybe a bit closer. Let's run it a bit closer. It was 1,045, I believe. Want to get it as close as possible. It's kind of hard. Okay, we'll put it there on the magnet. That is accurate, 1,046. Where is the 1.618? That number right there, 27,988 for gold. Your CD leg can take you to 27,988, to the doorstep of 28,000. At this time where I'm actually expecting a little bit of a sell-off, I'm telling you about the future to keep your spirits high, because everyone's going to get bearish and say bubble pop, it's all over. We'll get the price 3,819 at the moment, 27,988. Now, if you were to get there in short succession or in long succession, as I'd more likely expect it to be, you are going to do a multiple of 3,818. In fact, we do it the other way around. We're going 28,000. It's almost 28,000. These are not to be exact to the pence. The 161.8 should be met or slightly surpassed. 28,000. Divide where we are now. 3,8. Let's say you'll be able to buy at 3,800. 7 times, 7.36 times where you are right now. which in percentage terms is 636%. You'll make 636%. Almost did it the wrong way around. 636% from here. The other interesting thing about time and duration is as you get deeper into the 5 waves, typically these get faster. That's not the 5 wave we want. The first, the pullback. What tends to happen, the gradient gets steeper than the previous leg, and we are going up to here. So it can often happen in shorter time frame than the first leg's gradient, which could see you making it somewhere there. Then you have a pullback. It can be more volatile, so it can be sharper on the downside. And then you have your 5th leg going in. And we are talking right now about the D, the delta point CD, the 1.618, and it is 27,988 for gold. Right, let's take you to the crazy number, which is very moon boy of me, the 108,000. And what's associated with that? What could be associated with that? So I'm going to give you the same framing for one possibility. We've taken in this example the fact that that was a contained bull followed by a subsequent bear market, and this is a completely new, fresh, and beginning new bull market. What I'm going to say to you is, what if the real framing, the real macro framing for gold and precious metals is not about something that started in 2000? And for this, I will go back to the Oanda chart with the real history and switch the eyes off and take that Fibo off. What if the real commencement for all of this was the creation of the fractional reserve banking, which was the beginning of debt, over expenditure, debasement of fiat, and the inflation creation. The creation of inflation is governments that overspend. Simple as that. Because they are issuing more money by creating additional debt instruments at an accelerated rate. So, prior to the establishment of the Federal Reserve, 1913, which takes you back somewhere here, you actually had quite a long period of flat gold prices. Flat gold prices means there certainly wasn't a great loss of buying power in your dollar. Gold got the same price, you got the same amount of groceries for that price, and everything was hunky-dory. You're talking from 1833 to 1913, that's over here, I've overdrawn my pink cube, non-stop period of fixed gold prices. Now, I won't ever say certain things didn't go up. You'd have feasts, famines, droughts, and various other things. But I suspect they went up very slowly because the time the Fed needed to proliferate and create debt, hence why they kicked off 3 wars, 2 world wars and a brutal Georgian Bolshevik communistic implementation on the Orthodox Christian Russians, who were slaughtered en masse to the tune of somewhere between 20 and 60 million, the greatest genocide ever, followed by what went on in China when they introduced communism there. Those are the great world genocides, by the way, not other things that you might be deluded about. Nonetheless, if we take from 1913, let's find it, and say the beginning of debasement began here. You see that? It says 2012. What if the framing for gold is entirely different and it is all one big 5-wave? This is what financialization of everything does to your society. And let me just get it. There's 1911, 1905. Let's stretch it out. What if that's the framing? In short, your Elliott wave starts here in 1913. That is your AB leg. You have a 20-year pullback, which is your BC. And then you are advancing on a C and D leg, for which you are still in the C-D leg phase that started in 2000, 99-2000. Where does the 161.8% take you, you might wonder? in one giant 5-leg Elliott wave from the commencement of the Federal Reserve in 1913 at a fixed price. By the way, the suppression once you had a banking cartel, debt and borrowing during these years is part and parcel for the subsequent overperformance here. Manipulated by decree. And the fact it ripped to the degree it did in these eras shows that was the case. Instead of having the gradual bull trend, it had a long flat period by decree leading to a far more vertical trend. And guess what? That manipulation has actually been in a sly way around today along your silver and gold markets, and you're about to get the unleashing of being on the wrong side of that manipulation, the shorts, that will bring the same gifts, meaning this CD leg, let's label it for you. Here we go right back to the 1913 and we say
Make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market.